we're focusing on two foundational principles for the National Property and Casualty exam: insurable interest and the principle of indemnity. Insurable interest is the financial stake a person has in a property. If you would suffer a financial loss from the property being damaged or destroyed, you have an insurable interest. The most critical point for the exam is that for property and casualty policies, insurable interest must exist at the time of the loss. This is a frequent trick question, as the rule is different for life insurance. For example, if you sell your insured house on Monday and it burns down on Tuesday, you no longer have an insurable interest and cannot collect on the policy, even if it's still active. The new owner is the one with the financial stake. This concept extends beyond simple ownership. A mortgage lender, for instance, has an insurable interest in your property because a loss would jeopardize their collateral for the loan. Similarly, a contractor who places a mechanic's lien on a property has an insurable interest up to the amount of that lien. In both cases, their potential for financial loss gives them a right to be protected by insurance. This leads directly to the principle of indemnity, which states that insurance should restore you to the financial position you were in just before the loss occurred, but not allow you to profit. The purpose of insurance is to make you whole, not better off. For instance, if your 5-year-old roof is destroyed by a storm, the principle of indemnity means the insurance payout should reflect the value of a 5-year-old roof, not a brand new one. Unless you have a specific replacement cost policy, the payout would be the actual cash value, which is the replacement cost minus depreciation. The exam will test this by presenting scenarios where an insured might try to overstate a claim. Remember that indemnity limits recovery to the actual loss. These two principles are directly linked. The amount of your indemnification or compensation is limited by the extent of your insurable interest. The mortgage lender with a $200,000 loan balance on a $500,000 home can only be indemnified for their $200,000 interest, not the full value of the home. A simple way to remember the core of indemnity on your exam is the phrase, "I'm no better off, I'm no worse off." For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.